You probably know someone who makes decent money and still can't seem to get ahead. They're not buying yachts. They're not gambling. They're just using their credit card, groceries, gas, a few dinners out, maybe a flight or two, normal stuff. And yet somehow, month after month, the balance never really goes away. That's not an accident. Credit cards are one of the most sophisticated financial products ever built. They are convenient, rewarding, and deeply profitable, mostly for the people who issue them. Today, we're going to look at exactly how that happens and why so many people who aren't bad with money still end up losing ground because of a card in their wallet. Let's start with something simple. When you pay cash for something, you feel it. There's actual friction. You hand over physical money, you watch it leave your hand, and your brain registers the loss. When you tap a card, that friction disappears. Psychologists who study spending behavior have consistently found that people spend more when they pay with cards than when they use cash. The exact numbers vary by study and context, but the direction is consistent. Less pain at the point of purchase means more willingness to spend. Credit cards don't just reduce that friction, they actively reward you for spending. Points, miles, cashback. The more you swipe, the more you earn, which means the card isn't just removing the psychological cost of spending. It's flipping it into a psychological reward. That's a powerful combination. You feel good spending. You feel nothing losing the money, and you get rewarded for doing more of it. This is not a flaw in the system. It is the system. Now here's where things get expensive. Every credit card statement shows you a minimum payment. It's usually small. Sometimes it's a fixed amount. Sometimes it's a percentage of your balance, often somewhere around 1 to 2%, and the statement is designed so your eye lands on that number first. The minimum payment exists to keep you current. It keeps you out of default. It keeps your account in good standing. What it does not do is meaningfully reduce what you owe. Here's why. Credit cards charge interest on your remaining balance. That interest gets added every month. If you're only paying the minimum, most of what you're paying goes toward interest first, and barely anything touches the actual debt. Your balance shrinks at a pace so slow it can feel almost invisible. The result is that a relatively modest balance, the kind many people carry without thinking much about it, can take years to pay off if you're only making minimum payments. And over that time, you end up paying a significant amount in interest on top of what you originally spent. The minimum payment isn't a repayment plan. It's a revenue model. Credit card interest rates are high. In many markets, average rates sit somewhere between 20 and 30% annually, though this varies by country, card type, and your credit profile. 20% doesn't sound catastrophic until you understand what it means in practice. It means a balance you're carrying month to month is growing by roughly that percentage every year, compounded. Not in some abstract investment sense, but in the very real sense that your debt is increasing while you sleep. Compare that to almost any other type of borrowing: mortgages, car loans, personal loans, even most student loans. Credit card rates are almost always higher, often by a significant margin. That's because credit cards are unsecured debt. There's no house or car that the lender can repossess if you don't pay, so they price in that risk, and you pay for it. Most people are vaguely aware that credit card interest is high, but they don't feel it as a concrete number because the statement doesn't show you paid this much in interest this year. It shows you a monthly charge that looks small, and by the time you add it all up, you've spent more on interest than you ever intended to spend on anything. Here's something many cardholders don't fully understand. Most credit cards have what's called a grace period. If you pay your full balance every month before the due date, you typically don't pay any interest at all. The card is essentially a free short-term loan. This is how the cards are marketed. This is what the rewards are built around. And for people who pay in full every month, it genuinely works that way. But the grace period is not permanent. It's conditional. The moment you don't pay in full, even once, most cards will start charging interest on your entire balance, sometimes including purchases you made before the statement even closed. The exact rules vary by card and by country, so it's worth reading the terms of your specific card. But the general principle holds: carry a balance and the grace period disappears. This is the gap most people fall into. They have one expensive month, a car repair, a medical bill, a trip. They can't pay the full balance, so they pay what they can. And from that point on, every new purchase starts accruing interest right away. The free loan they thought they had is gone, often without them fully realizing it. Let's talk about the rewards for a second, because a lot of people use them to justify their spending. Cashback and points programs are real. They do have value, but they are designed around an assumption that works in the bank's favor, that you will spend more than you would have otherwise, carry a balance at some point, or both. The math on most rewards programs only favors the cardholder if you're paying your balance in full every month, without exception. The moment you're carrying a balance and paying interest, the interest charges almost always outpace the rewards you're earning, often by a wide margin. There's also a subtler issue. Research on consumer behavior suggests that people who are focused on earning rewards tend to spend more in general. The reward reframes spending as a productive activity. You're not just buying something, you're earning points. That mindset shift is worth something to the card issuer, even if it costs you. Rewards are a real benefit for a disciplined user. For everyone else, they're often a net loss that feels like a win. Here's the part that makes this complicated. Credit cards are also one of the most effective tools for building a credit score, which affects your ability to borrow money for things that actually matter. A mortgage, a car loan, sometimes even a rental application. So there's a genuine reason to have and use a credit card, even if you could technically live without one. The problem is that the same system designed to help your credit score is also designed to make carrying a balance feel normal. Credit utilization, how much of your available credit you're using, is a key factor in most credit scoring models. Low utilization is good for your score, but if you're carrying a balance month to month, your utilization is never actually zero. And if you're also paying interest, you're paying for a credit score benefit that could theoretically be achieved by using the card and paying it off in full. The credit card industry has created a situation where participation in the system feels necessary, and where the most profitable customer behavior for the issuer overlaps with behavior that looks responsible on the surface. So why do credit cards make people broke? Not because they're inherently evil, and not because the people using them are financially irresponsible. It's because every part of the product, the rewards, the minimum payment, the grace period, the interest structure, the way the statement is laid out, is optimized to keep you spending, keep you carrying a balance, and keep you paying interest month after month. The card works for you if you treat it like a tool with specific rules. Pay the full balance every month. Understand when the grace period ends. Don't let the rewards change how much you spend. Know your interest rate and what it actually means. It works against you the moment it starts feeling like free money or an emergency backup, or a way to earn rewards on things you were going to buy anyway, but a little more of. The most important thing to understand is this: credit cards are not neutral. They are profitable products built by companies with a clear financial interest in how you use them. That doesn't mean you shouldn't use them. It means you should use them with your eyes open, because the people who benefit most from credit cards are either the ones who never carry a balance or the ones who do. And only one of those groups is the card company.